Hello, everybody. Hope you've been well, that you had a good week. It's been a rough market, it's been a rough market certainly last week, and so far this week we had a market that held up remarkably well yesterday in the face of rising bond yields. Today, not so much. Today we've got more of an issue. By the way, we have a special treat. If you're hearing the snoring, it's not just Max anymore, but maybe you can see behind the table we got Max and Bailey having a snooze here. It hasn't been dog days. It's been autumn days. A lot of rain here, and kind of depressing. But we're supposed to get some sun coming out. I read an article that the foliage is starting to come out up north in Vermont, and that the locals are getting really upset about the Instagrammers, the influencers that are coming up there with entourages of makeup artists and wardrobe artists, because they want to get their pictures taken up there with all the pretty leaves. So I guess it's always nice to go up there, but it's getting more and more crowded, and now you've got the selfie crowd, the Instagram crowd. So be careful if you go up there. It's probably going to be jammed. Well, let's talk about what I'm supposed to know something about, that you care about, and that's the financial markets. Last week, we had another Powell press conference following the FOMC, and Powell stressed that, and this summary of economic projections showed that the committee has decided to more or less keep its current stance through the end of the year, and the current stance implies that there'll be one more rate increase over the rest of this year. Not much left. But then the implication of the SEP for next year is, instead of cutting the federal funds rate by 100 basis points from 5.6 to 4.6, now they're talking about cutting it by 50 basis points. And that rattled the market. It's a interesting kind of environment. I find myself most of last year, early this year, in a position of arguing why the economy wasn't going to go into a hard landing. Now I find myself in a position of trying to explain why I think that the economy is going to slow from this no landing scenario that we're having here in the third quarter. The economy is turning out to be very strong in the third quarter. Powell in his press conference did acknowledge that there are some issues up ahead here that could weigh on economic growth and could have some impact on monetary policy. For one is the strike. He said that the Fed obviously doesn't comment whatsoever on the strike, doesn't have a position on the strike, but it is an issue, clearly implying that if the strike lasts for a while, it could certainly mean that fourth quarter real GDP could actually be down, especially if we get a government shutdown on top of all that. In addition, a strike, if it's settled with if it's settled in a way that leads to high wages for the workers, that could certainly set a precedent and be inflationary. I pointed out that organized unions in the private sector account for only 6% of the private payrolls, whereas back in 1984, which is the data that I have, I don't have anything prior to that. Back then, labor unions accounted for 16% of the labor force. So that implies, I think, that probably during the 1970s, labor unions might have accounted for about a quarter of the labor force. So they had much more impact, direct impact. They had cost of living adjustments, but clearly it's something to be watchful of. With regards to the shutdown, he mentioned it. He did mention that that the Fed is data dependent, and the Fed may not have some data when the government shuts down. Some of the agencies that produce data will be shut down. So we're talking about kind of important variables like the CPI, PPI, payroll, employment, that kind of data won't be around. So we'll have to rely on survey data and kind of wing it for a while. The Fed is not the only data dependent entity. As you know, Yardeni Research and other research providers, top down macro research providers, depend on data provided by the government. He mentioned that another kind of headwind here is yields. He didn't mention that the Fed may have something to do with yields back up here. Quantitative tightening has certainly contributed to some increase in the bond yield. I think the Fed stance that they're not going to that they're going to want to maintain their restrictive policy next year. That obviously got the bond yield above 4.35%, which was its high of last year, and now here we are at 4.5%. He didn't mention at all fiscal policy. The Fed has this rule, this view that in order to maintain their independence, they can't comment on anybody else's economic policy making, particularly in the fiscal realm. But clearly, a lot of the problems in the bond market have something to do with the outlook for fiscal policy. There's a widespread view that the widening of the deficit over the past few months has been attributable to Biden's economic packages that were passed in 2022. That's not correct. The fact of the matter is that kind of spending is still ahead of us. What really has widened the deficit is inflation. Inflation has caused the Fed to raise interest rates, and that has led to the rapidly rising net interest costs that the government has to pay. That's not a discretionary item. That's non-discretionary. It has to be paid, and it is what it is. Whatever the bill is, that's what they have to send a check for. And the other thing that happened is we had a huge increase in capital gains tax receipts last year. People panicked out of the stock market. A lot of them had substantial capital gains still, even though they took some hits on those gains. But that led to a big inflow of tax receipts last year, and that basically kind of dried up a few months ago. And then we've had inflation lead to a upward adjustment in Social Security payments. So it all adds up right now to a $2 trillion federal deficit on a 12-month basis. But the projections are that it's going to stay here, maybe even get worse as some of the Biden administration's spending programs kick in. So that's a concern in the bond market, and I'm concerned about it in the sense that I coined the expression bond vigilantes back in 1983. And my concern here is that the bond vigilantes don't like anything of what they're seeing here. They may very well appreciate what the Fed's doing in terms of its willingness to be restrictive and slow the economy down in order to bring inflation down. So you would think that that would be a positive for the bond market. But the reality is that the large deficit is a major concern to the bond vigilantes. So the fiscal policy side, I don't know, maybe Biden administration needs to bring in James Carville as a consultant here, because James Carville, back in the early 90s when we had Bill Clinton as president, Carville said, you better not run a big deficit because the bond market's not going to like it. And the bond market's very powerful. He said when he's reborn, he'd like to be reborn as a bond market. Kind of a strange concept, but I guess he wanted to be even more powerful than he was back then at that time. Powell mentioned strikes, shutdowns. He did not mention no data. He mentioned student loans as another kind of headwind up ahead here. He mentioned yields, and he mentioned oil. And again, he did not mention fiscal policy. So where are we now? Well, let's have a look at a couple of our charts here. I'm sharing here. This is from the quick takes that we put out a couple of days ago, September 24th. Today, September 26th. So just a couple of days ago, and this is still very relevant. I'm not a technician, but kind of like to look at charts, and every now and then I like to draw some lines on these things and just occurs to me that there is a channel here that the bull market has basically followed since since the bear market ended on October 12th of last year, and it's pretty it's pretty, and it's clearly visible to the naked eye here without a magnifying glass. You need a little bit of a magnifying glass to discern the colors here, but we know that the stock market, the S&P 500, tested its 50-day moving average, kind of bounced off of it, and now it's back down below it pretty decisively. This is through this is through September 21, of course, because it's as of the 24th. Anyways, we are seeing this market taking a dive here. We did think back here that that could be it for a little while. We got to almost 4,600 by July 31st, and we thought we'd get there by the end of this year. Rather than boldly raise our numbers, we concluded that we're ahead of schedule, and we're not rushed. We don't think this thing needs to be rushed, and that the market has to kind of catch up with the fundamentals. The earnings projections are improving slowly. As a matter of fact, forward earnings for the S&P 500 are at an all-time record high. But on August 1st, we saw that the government debt was downgraded in its rating, downrated from AAA to AA plus. And as a result of that, everybody started to focus on the bond market again. And so the bond market, as a result of that, started trading just above 4%, between 4% and 4.35%, and now it's above that at 4.5%. So that's getting people's attention, and I think it's one of the main reasons that the market's coming down here is the valuation multiples are coming back down. Question is whether we're going to, I think we're going to retest, we're going to test the 200-day moving average. I think we're going to bounce off of it, but that'll be kind of a critical point to watch. Well, so much for my amateur technical analysis. Let me go to my my charts for Monday. And so we'll go to the morning briefing. We'll go to the bullet points and charts, and we'll go to Mondays. On Tuesday, as you may have seen, we wrote about Powell's path, whether it's moderating, whether it's widening or narrowing. Powell's talked about a path to a soft landing, and he was kind of mixed in his presser. He kind of suggested that he thought it was narrow, but maybe it's widening. He's not quite sure. But we kind of took position that it's still fairly narrow. Even though we're optimists, we did raise our recession probability from 15 to 25%. A lot of that is because of the bond market, because of what we see happening in the bond market. As a result, the concerns about the fiscal deficit. But let's go to Mondays. In Monday, we were addressing some of the indicators that have been pointing towards a recession, and we explained why we aren't convinced that they're going to work. But again, we try to be balanced about these things. But with regards to M2, the hardliners have been looking at a chart like this. They've been looking at the year-over-year percent change in M2 and pointing out that it's negative in current dollars. It hasn't really been negative before since the data starts in 1960. Our position is, yeah, but if you take a look, well, first of all, you can just look at this chart and realize that some of this has to do with year-over-year comparisons, and you have to factor in that there was a huge increase in the year-over-year growth rate in M2 back here. So on a year-over-year basis, this is actually makes a lot of sense. When you look at the actual level, you can see that we're still well above the pandemic level, the pre-pandemic level of M2, and we're still above the upward trend of that line. So it doesn't really, we just don't get the argument that M2 is, should be on a list of reasons to fear a recession. You can also do this thing in real terms, which probably makes more sense if you want to compare it to real GDP. By the way, a lot of this has to do with the so-called velocity of money formula, MV equals PY. Remember that from your Econ 101 class? Well, M is, let's say in this case, M2. And it's not clear whether M is the demand or supply. The data itself is called monetary aggregate. But I think idea in MV equals PY is that M is actually the supply of money. So if the Fed increases the supply of money, multiply that by velocity of money, and you get nominal GDP, which is PY. So if you divide MV by P, you get real money supply times velocity equals real GDP. Again, the assumption is that M is supply. And the assumption is, I think, that velocity is either constant or predictable, and it hasn't been either. So it's really just a mathematical identity. It's just an equation without any real forecasting power, in my humble opinion. But I don't want to go too far along those lines because Nobel Prize winners like Milton Friedman obviously were big proponents of MV equals PY. So here's another chart. Let me just change glasses here because I'm looking at things a little bit more closely. This shows you M2 versus nominal GDP. Correlation is meh, as they say, not so great. Same thing here with real GDP and real M2. And then here's the actual velocity number. And maybe back here, when Friedman was around, was relatively stable. But of course, just as monetarism got some fans, velocity stopped being predictable or stable. It went up for no particular obvious reason at the time. And it's been going down for no particular reason or predictable reason at the time. And now it looks like it's bottoming here. So it's all over the place. And we're just not big fans of the M2 as an indicator of the economy. On the other hand, there are some kind of tautologies, some realities here, and that is when people save, they put it somewhere. And a lot of people put it in various kinds of assets, including M2 kind of assets. M2 has become more popular to put your money in because you can now get 4 or 5% on deposits and money market funds. But look at this correlation between the year-over-year change in M2 and the 12-month sum of personal savings. So we know what's been happening here. There's a huge increase in personal saving back here. It went into M2. M2 is slowing, but it's still at well above its pre-pandemic high, and it's above its upward trend. So this kind of relates to the excess savings idea. The idea is that the consumer is going to run out of excess savings shortly, and that will lead to a consumer-led recession. Again, we're not sure we really buy that. Consumers did save a lot. I'm not convinced that they spent it all. What they did is, by saving a lot, they were then able to reduce their saving subsequently and maintain their consumption. Meanwhile, net worth is at an all-time record high, something like $35 trillion since right before the pandemic. So there's a lot of net worth. I understand it's not evenly distributed. There's inequality, of course. But in terms of the macro situation, there's a lot of increase in net worth that might very well reduce the impulse to save. So let's look at some of that. This is just M2 versus a weekly series that the Fed provides on total deposits. The Fed stopped publishing M2, but we can get on a weekly basis, but we can get the weekly data that comes close enough. And it actually looks like it's starting to flatten out a little bit. I don't know if you can see that. You may need to come closer to your screen, but it's starting to flatten out a little bit, which is kind of interesting. And then here's another take on all this liquidity that's out there. If all this savings went into liquid assets, and then they were supposed to have started writing checks and paying their bills on all their post-pandemic spending, why is total deposits and money market funds at an all-time record high up here? And notice, I don't know where you want to draw the trend. There's a little trend here, but relative to this trend, we're well above that. So it seems to me that there's still a lot of just cash that's been saved. And all it's really done is reduce the need to save much more, which has helped to boost consumer spending. So here's net worth all-time record high. Here's net worth over disposable personal income, also near record highs. One of our accounts looked at this chart and said, okay, the next thing it's going to do is take a dive. Everybody's entitled to an opinion on these things. This is real disposable personal income versus personal consumption expenditures in real terms. And again, you can see that the consumption was hit by the pandemic. Notice that real consumption is actually back to its trend. It's as though that as long as people have jobs and have income, they have a certain path here for real consumption, and everything else kind of adjusts around that, particularly personal savings. So I think that's what we're seeing in this chart. And you can see that the difference is personal savings in real terms, and it is less than they were doing back here. Maybe it's about to widen again, but I think it may stay relatively low, which means that if disposable income in real terms continues to increase, which I think it will with employment gains and real wages going up, then consumption continues to grow. Hence, no consumer-led recession, no sudden slamming on the brakes. Let's see what else I want to touch on here. I think I went into leading indicators, and you know my story on the inverted yield curve. I also looked at bank loans, and that growth rate is starting to slow down. So there's some signs of that credit conditions are tightening. That's no surprise. That's kind of covers what I wanted to cover. Let me stop sharing here. Let me start answering some of your questions, responding to some of the points you have here. Okay. Let me put on my other glasses here. What's your take on the 10-year yield at 4.5%, yet the Fed dot plot has the Treasury declining to 3.5 to 4% by 2026? Seems like there's a lot of noise, including shorts on the Treasury and U.S. dollar appreciation against foreign currencies. Well, my take is that we have been returning to the old normal. The old normal being what things looked like, particularly in the bond market before the great financial crisis. So the new abnormal was the period between the great financial crisis and the great virus crisis. And during that new abnormal, we had interest rates abnormally low. We even had negative interest rates in some parts of the world, and we had lots of quantitative easing where balance sheets of central banks ballooned. Well, that period is over. The rebound in inflation around the world has achieved what central bankers wanted to achieve. They wanted to get inflation back to 2%. Well, they got it, and more so, more than they bargained for various reasons. I think it was a combination of monetary stimulus with pandemic fiscal stimulus, and of course the Russian invasion of Ukraine. A bunch of things came together, and as well as there were inflationary consequences or shocks of the pandemic with supply chains, and then that fed wages, and so we've had a wage price spiral. We've had a wage price rent spiral. So there's been a lot of inflation, and that's occurred at a remarkably rapid pace. It's kind of like the 1970s on steroids. As a result of that, central banks are back to fighting inflation. And as a result of that, the bond market has kind of repriced the environment. It's no longer the great moderation, which is what we had back in the mid 80s, early 90s. It's not the abnormal environment that we had between the two crises. It's kind of back to where we were in 2003, 4, 5, 6. And back then, the TIPS yield was 2%. The inflation premium between the 10-year and the TIPS was 2.5%, 2.5%. So that gives us 4.5%. So that's kind of where we're back to. The TIPS yield now is above 2%. The inflation premium is slightly below it. but they add up to 4.5% right now. So I think we're kind of back to normal, and 4.5% is probably where the bond yield should be. But nothing is as it should be. Sometimes things are different, and what's different this time is fiscal stimulus is remarkably out of control. And so the supply issue, which has really never been much of an issue for the bond market, because deficits tended to widen during recessions. Well, now it's a big deal, and because this time around we got the deficit widening when the economy is doing well and inflation's high. With regards to the dollar, I think the dollar should be strong. I think to a large extent the dollar is determined by the relative perceptions of economic growth and resilience of their economies. And our certainly looks a lot better than Europe, looks a lot better than China, looks better than Japan's. And so I think the strength of the dollar owes something to that. Also, the fact that the Fed is talking about being restrictive longer into next year has obviously also boosted the dollar. Let's see. And by the way, that should help bring inflation down. Vincenzo, it seems there are very large short position in the bond market. Do you think there's any possibility that any authority comes out banning temporary shorting bonds, as some shorts will temporarily forbidden back in the subprime crisis? I don't think so. I haven't heard it. You're the first that's mentioned anything like that. You got Ackman touting that he shorted the 30-year when it was 4.16%. Now it's 50 basis points higher than that. So he's done extremely well with that trade. And it's not because he said he's shorting it that the bond yield's at 4.5%. I don't think it's because of all the shorts. I think it's the underlying fundamentals have worked to the advantage of the shorts so far. But I don't really recall in quite some time seeing this much fear in the bond market. It's been unrelenting in the drive up here in bond yields. So from a technical standpoint, a sentiment perspective, there's probably some room here for a rally in the bond market. What it would take is that the next batch of economic indicators suggest that things are in fact slowing down, which I think is possible, and it certainly would help if the next CPI is the fourth in a row where things are moderating. It would really help if the rent inflation component helps do that, and then we may not have a CPI or PPI release for a while until the government until they decide to reopen the government. Got a couple more minutes here. Denise, could the Fed actually be stimulative with majority of consumer debt below 4% and saving rates over 5%? The Fed actually be stimulative? Well, as you know, Denise, right now the Fed's doesn't want to be stimulative. It wants to slow things down. If things get too slow, I mean, certainly lowering interest rates, I think, would revive the economy. That's not my scenario. My scenario is that we continue to have these rolling recessions and the overall economy remains resilient. I am working today for tomorrow on a short piece on why the employment market is so strong. I mean, construction employment, all-time record high, trucking, warehousing, near all-time record highs, restaurants, all-time record highs. A lot of it has to do with demography. A lot of it has to do with the underlying strength of the consumer, the baby boomers having a lot of net worth that they may be spending as they're retiring. Chip, in this week's brief, there appears to be abnormal discounts in small and mid-caps PE ratios. Do you see this as an anomaly, or are there structural influences? We'll double check that. Thanks for pointing it out. I did see it, and I thought it was just, here we go again. These mid caps look awfully attractive. They're definitely cheap, and their valuation multiples increased some in the first half of the year, and then it all kind of evaporated very quickly here. I mean, small caps, mid caps don't do very well when people fear a recession. And so, again, right now, most people aren't fearing an immediate recession, but they're starting to worry that maybe the economy is too strong. Maybe inflation isn't going to come down. Fed's going to have to raise interest rates a lot more, and that'll completely shut off the path to a soft landing and force the Fed to bring. One of my dogs isn't happy. Force the Fed to bring interest rates down. So that's where it is. I think I got one more question here. We're returning to the old normal rate wise, but isn't possible due to much more debt. Please comment. Seems you can't have high rates and high debt long term. That's a very complicated question. Trying to understand. Oh, somebody was really not happy. They're good guard dogs. I guess somebody's coming. Probably just Amazon delivering something. I'll think some more about that. I have thought about it. I mean, this gets into the idea of the real interest rates. Is the real interest rate sort of that equilibrium nirvana rate? Is it higher now than it had been in the past, and so on? But run out of time. I promise I'll give it more thought and write something about it. And you're welcome to raise the question next time. So have a good week. It looks like it's starting out as a rough week. But September is a rough month sometimes historically, not always. Sometimes October is as well. So I still think we're going to be set up for a year-end rally. So I kind of said that September is when we're supposed to go apple picking, but some of those apples can be rotten. But I think we may find some value here in the next few weeks, next couple of weeks going into October, and then Thanksgiving to Christmas rally, I think is possible. Still holding on to that, returning back to 4,600, but stay tuned and we'll keep you apprised of our thinking. Thanks, everybody.